Tax is a compulsory contribution to state revenue levied by the government on workers' income and business profits or added to the cost of some goods, services, and transactions. Tax system is a set of taxes enforced in a country at a given time. What are the characteristics of taxes? Firstly, it is an enforced contribution where element of consent is not required, and the act of tax evasion by the taxpayers will be punished by the law. Secondly, it is proportionate in character. Payment of taxes are based on the ability to pay principle, where the rich are levied a higher amount of tax compared to the poor. Thirdly, it is levied by the state. In Malaysia, the Inland Revenue Board of Malaysia, IRBM, are in charge of matters involving taxes. The IRBM is one of the main revenue collecting agencies of the Ministry of Finance. They act as the agent of the government and are responsible to provide services in administering, assessing, collecting, and enforcing the payment of taxes. What are the importance of paying taxes? Taxes are important for redistribution of income. It influences the allocation of resources by transferring resources from the private sector to the government to finance public investment programs. Besides, taxes collected are used to build or improve social infrastructures for public use, such as roads, hospitals, schools, and public services. Taxes are also important to raise government's revenue, which will be used to finance social projects and meet public's demands. This includes to cover the cost of administrative services provided by the state to the public.
In general, there are two types of taxes, which are direct and indirect taxes. Direct tax is a tax that imposed on income and profit that cannot be passed on to others. This tax has to be paid directly by the individuals or organizations concerned. Income tax is one of the examples of direct tax. It is a tax on personal income and business income. The Income Tax Act of 1967 requires the government to collect this tax to fund the government services, pay government commitments, and give commodities to citizens. Corporate tax is the next example of a direct tax. A corporate tax is a levy on a company's profits. As a source of revenue, the government collects this tax. Taxes are calculated on taxable income after all deductions have been made. Moving to indirect tax. Indirect tax is a tax levied on goods and services. The tax burden might be moved to another individual since the tax is paid by one person but recouped by another. One of the examples for indirect tax is sales tax. It is a tax collected by the seller and paid to a governing body for the sale of specific products and services. It is usually computed as a percentage of the purchase price. Another example for indirect tax is goods and services tax, also known as GST. GST is a value-added tax on products and services sold domestically for consumption. This tax is included in the final price and paid by the customer at the moment of sale, after which it is passed on to the government by the seller.
The tax system has been reported to be one of most important systems of both economic development and for the servicing of government expenditure in both developing and developed economies. Islamic tax system has been used in several countries together with a conventional system of taxes. Countries like Malaysia, Indonesia, and Pakistan has been mixing Islamic taxes and conventional systems of taxation for revenue generation. Turkey has one of the most competitive corporate tax rates among OECD members countries. The Turkish corporate tax legislation has noticeably clear, objective, and harmonized provisions that are in line with international standards. The Turkish tax legislation may be classified under three main headings: income taxes, taxes on expenditure, and taxes on wealth. In Indonesia, there is a wide variety of taxes that companies, investors, and individuals need to comply with. This includes corporate income tax, individual income tax, withholding taxes, international tax agreements, value-added tax, luxury goods sales tax, custom and excise tax concession, and land and building tax. Interestingly, there is no personal income tax in Saudi Arabia. But a flat income tax rate of 20% is applied to the tax-adjusted profit of resident non-Saudi and non-GCC individuals. So what is non-GCC resident? Non-GCC residents include those who do not hold a resident visa in United Arab Emirates, Oman, Kuwait, Bahrain, Qatar or Saudi Arabia.
Taxes have a key role in sustaining the economic growth of a country. However, there are many issues related to taxation. One of the most common issues faced by countries that impose tax is tax evasion, which is when a person or an entity uses illegal means to avoid paying taxes. This will lead to a negative impact in the economy, such as depriving the government of the money needed to carry out laws and initiatives, and also the funds needed to improve health, education, and other government programs. One of the tax evasion cases in Malaysia was in early 2021 when the High Court ordered the associates of Jolo from the 1MDB case to pay 9.1 million ringgit for tax evasion over several years. The next issue related to tax is double taxation, which is when the income tax is being paid twice on the same source of income. It also refers to when the same income is taxed by two different countries. In order to resolve this, double tax agreement was established. Double tax agreement is a settlement between two governments to avoid double taxation, which allows both trading countries to be more interdependent economically and socially. In Malaysia, double tax agreement apply to the taxes of the taxpayers of Malaysia and also the other country involved. The type of taxes covered is income tax and petroleum income tax. As of 2021, there are 75 countries that have signed the double tax agreement with Malaysia, including major countries like the United States, United Kingdom, China, Japan, and many others. However, there are still countries that have not yet signed the double tax agreement with Malaysia, like Brazil, Greece, and many others, which means they are still citizens with their income being taxed twice, both in the country of residence and also in the country of origin of income.
Taxation can have an impact on many aspects of the economy, including production, income distribution, inflation, and employment. When taxes are imposed, it affects so much the ability to work for poor people because taxes reduce the disposable income of the taxpayers. When the disposable income of these people reduce, the buying capacity and the ability to consume also will reduce, and this will cause the standard of living starts to decline slowly. When disposable income decrease, saving will decrease too, and there will be less saving resources that are available for investment in capital formation. Lower rate of investment decrease the economic growth of a country. Also, when taxes are expected to be imposed and will be continued forever, it will reduce the willingness to work of the taxpayers because they have a feeling that every tax is a burden and they feel that it is not worth it taking extra responsibility and start to alter their preference from work to leisure. It is because so much of their extra income will be taken away by the government in the form of taxes at the end of the month. Increase in tax will lead to decrease in disposable income because it takes money out of households and leaves them with less money to spend and saving. Lower savings encourage taxpayers to cut their consumption and spend less just in case anything happens in the future. Tax also reduces the purchasing power of the taxpayers because increase in price of goods and services reduce the consumption and demand for consumer goods like foods, beverages, clothing, gasoline, and many more. The higher the tax, the stronger the disincentive to work because tax burdens discourage employees from hiring. That will reduce the incentive for the unemployed to seek for a job and make current employment to work longer and harder.